The numbers are lying to you. Let me tell you something the government doesn't want you thinking about too hard. You go to the grocery store, you grab the same stuff you always grab: eggs, bread, chicken, maybe a couple snacks for the kids, and you get to the register and your stomach drops. Again. It's not your imagination. This has been happening for years, and it's about to get worse. Because here's what nobody's telling you. The inflation numbers they report don't measure what you actually feel. And what's coming, the stuff baked into the system right now, could hit harder than anything since the 1970s. When the government says inflation is at 3%, they're measuring something called the CPI, the Consumer Price Index. Sounds official, doesn't reflect your real life. The CPI basket gets reweighted and adjusted constantly. When beef gets too expensive, they don't say beef got expensive. They say people are substituting to chicken and adjust the weighting. When your rent jumps 40% in 3 years, but the official rent metric lags real market prices by over a year, the headline number looks calm while your bank account is on fire. Real inflation, the stuff hitting your wallet, has run hotter than the headline number for years. Housing, insurance, childcare, healthcare. These are the categories eating families alive, and they're exactly where official numbers understate reality. You're not crazy. You're not bad with money. The math genuinely doesn't work like it used to. Why this time is different. Every generation thinks their inflation is the worst. But look at what's stacking up right now. First, the debt. The national debt just blew past levels that used to be considered a five-alarm fire. Trillions upon trillions. And here's the scary part. Just paying the interest is now one of the largest line items in the entire federal budget. Bigger than defense. When a government owes that much, it has two options: raise taxes and cut spending, political suicide, or let the currency quietly lose value so the debt gets cheaper in real terms. Guess which one they always pick? Second, the money supply. During the pandemic, trillions were pumped into the economy in a short window. That money didn't disappear. It sloshed around, bid up asset prices, bid up home prices, and a huge chunk is still working through the system. You can't flood an economy like that and expect prices to calmly return to normal. That's never once happened in history. Third, supply chains are still fragile. We like to pretend the last few years fixed everything. They didn't. Tariffs are back on the table in a big way, and tariffs are a tax, one that gets passed straight to you at checkout. Every time you hear tariffs on imports, translated to prices go up. Fourth, wages aren't keeping pace where it matters. Nominal wages went up, sure, but adjusted for what things actually cost, housing, healthcare, education, most working and middle-class families have less purchasing power than a few years back. You're working just as hard, maybe harder, and somehow falling further behind. That's not personal failure. That's the system working exactly as designed. Who wins? And what's coming next? Who actually wins from this? Here's the part that should make you angry. Inflation isn't random. It doesn't hit everyone equally. It's basically a hidden tax on people who hold cash and wages, regular working people, and a gift to people who hold assets, stocks, real estate, businesses, hard assets. If you already own a house, inflation helps you. Your mortgage stays fixed while your home's value climbs. But if you're trying to buy a house right now, you're getting crushed from both sides. High prices and high rates at once. That combo made home ownership feel like a fantasy for an entire generation. Meanwhile, companies figured out something dark. When everyone expects prices to rise anyway, businesses can raise prices more than their actual costs went up and blame inflation. Economists call this greedflation, and there's real data showing corporate profit margins hit record highs the exact same years families struggled to afford groceries. Not a coincidence. Opportunity. So when someone tells you inflation is just supply and demand, nobody's fault. Ask why record corporate profits happened at the exact same time families were skipping meals to make rent. What's coming next? This is the part that should really get your attention. We're watching a setup that historically doesn't end quietly. Combine massive government debt that keeps growing, a political system that won't agree to cut spending, a Federal Reserve stuck between fighting inflation and not wanting to crash the economy, an aging population needing more healthcare and retirement spending, and a global environment where the dollar's dominance is being challenged for the first time in decades. And you get a recipe where the easy political choice, over and over, is letting inflation run a little hotter instead of making hard decisions. Small doses, over and over, until one day you look up and your dollar buys half of what it used to. This is exactly what happened in the 1970s. A decade of inflation the government kept insisting was temporary, right up until it wasn't. It took brutally high interest rates and a painful recession to fix it. People who lived through that remember what it did to their savings and their sense of financial security. We might be at the start of a similar chapter. Not identical, history doesn't repeat exactly, but the pattern rhymes enough that it should have your attention. What you can actually do. I'm not just here to scare you and leave you hanging. Let's talk about your money. 1. Stop keeping large amounts of cash sitting idle. Cash is a guaranteed loser against inflation over time. An emergency fund is smart. Beyond that, idle cash quietly loses value every day. 2. Assets tend to outrun inflation over the long run. Historically, stock ownership, real estate, and business ownership have been the best long-term inflation hedges. Not magic just because businesses can raise prices along with inflation, and real assets hold real value. 3. Pay attention to debt. Fixed-rate debt, like a mortgage locked in years ago, works in your favor. You're repaying it with dollars worth less over time. But high-interest variable debt, especially credit cards, becomes more dangerous. That's the debt to kill aggressively. 4. Think about income, not just savings. The biggest protection isn't a perfect portfolio, it's earning power. Negotiating raises, building skills, adding income streams. Income that grows with inflation beats a static pile of savings that can't. 5. Stay informed, don't panic. This is slow-moving, not a sudden collapse. You have time to adjust. The people who get hurt worst either ignore it completely or panic and make emotional decisions. The bottom line. I'm not trying to be doom and gloom here. I make these videos because regular people deserve to understand what's actually happening to their money instead of a simplified story that doesn't match their reality. The inflation problem in this country is deeper and more structural than most people realize. Debt, monetary policy, corporate behavior, and political incentives are all pointing the same direction. More inflation, not less, over the coming years. You can't control the Fed. You can't control Congress. You can't control global supply chains. But you can control your savings, your debt, and your income. The people who come out ahead aren't the smartest people in the room. They're the ones who saw it coming early and adjusted before everyone else caught on. Don't panic, but don't sit still either. If this opened your eyes even a little, hit subscribe. I break down what's happening to your money in plain English. No jargon, every single week. Stay smart out there.